Heiberger Harrison here on Real Talk with Jamie. Today we're going to be exploring building financials. I will be going over both co-op financials and condominium financials with you. And we're going to be starting with co-op financials. And I'm using London Terrace as an example, simply because I feel I do a lot of deals over there and it just was what I had accessible. And I want to, before we go through the actual financials themselves, I just want to talk a little bit about how I view looking at financials, whether it's a co-op or condo. Keep in mind, every building runs differently. So you might find that there could be a co-op with 150 units that is running negative year after year, but yet financially they're strong. And why do I say that? Well, we need to see, first of all, how a building operates from one year to the next year, which is basically what you're looking at when you're dealing with building financials. And the other thing is, did they take the deficit from last year and what did they do to fix it? And if that's been working for that particular building year after year, then that's okay. There have been changes though. It used to be that a bank can look past certain requirements and still be able to loan at the building. Those restrictions have certainly changed since COVID, since post-COVID, since rates have gone up. And now it used to be that a lender would be able to do a feasibility study on, well, what would happen if? They don't allow that anymore. And basically they're looking at what is the industry guidelines, which is Freddie and Fannie. And under the guidelines, it used to be that you could look for something else to satisfy the reserve requirement, because Fannie Mae, they require on their loans, you have to show, the building would have to show 10% as a line item reserve that goes in annually, and it's 10% of the annual expenses. So, if they're doing it monthly or however they're going to be doing it, they want to see that as a line item. Now, let's just say hypothetically, they're not doing it, but they have a few $1 million in reserves. Well, it used to be that would be fine because that would be then given as exception, but it's not going to qualify now just because it's not meeting that guideline requirement. And so, but other than that, you still do loans. Loans are still done on exception. It's definitely changed and people do get denied more than they used to, but for the most part, it hasn't changed all that much other than the fact that a lot less people are borrowing money for the obvious reasons that rates have gone up. So let's go over, I'm going to be pulling up London Terrace. And what I like to point out to people that are trying to understand what's important to look at in a co-op or condominium financial statement, the way that I view it is, what can I find out about this building without being an accountant? I'm not looking at financials from an accounting perspective, nor do I think an accountant really should be looking at the financials anyway, because, well, I shouldn't say that. They shouldn't just be looking at the financials. No due diligence on any building, whether it's you're buying a rental building, you're buying it as a rental building, or you're buying a unit in a particular co-op or condominium. You're never just looking at any one set of due diligence paperwork. You're not just looking at the financials. You're not just reading the minutes. You're not just reading the house rules. You're doing all of it. You're asking questions of the management company. And the reason you're doing all of it is because together you can get the information that is important in being able to evaluate for your client whether or not this is a safe, solid way to go. We're not even assessing that. We're just giving the facts. The financials, though, can tell us part of the picture that most people don't pick up on. So when I'm doing due diligence, for example, I want to understand if my client's buying in a co-op, what are my client's closing costs going to be? And one of the ways that I'm going to find that out is, of course, simply getting that question answered from the management company. Maybe I'll go into another deal that I recently did there, and then I will reach out to the management company just to see if anything has changed since then. Financial statements are supposed to be audited, and they're supposed to be drafted within the first quarter of the next year. So for example, 2024 final financials are supposed to have been done by the May 31st of 2025. Most buildings do not have their financials done in the first quarter. They just don't. Doesn't mean that you can't do a loan there. There will be certain requirements that if it's a bank involved, that they will make sure they have the answers to prior to funding the loan. But there are ways around it, and it would be on exception. Now, I'm going to pull up now the London Terrace financials that I was talking about. And these are a co-op. I'm going to, after this, be pulling up a set of condominium financials. Financials, for the most part, will all look the same. Here we have the letter that's going to the board of directors after these financials were evaluated. When you're looking at a balance sheet, it's always going to be 1 year to the next year. So here it was 22 to 23. But interestingly enough, when you're looking at 23, these numbers are through the end of 23. So when we looked at the 23-24 financials, that information would have been at the end of 24. I'm venturing to guess we may not even have those 24s yet because it's just Q1. What might we do instead? Maybe we'll contact the managing agent and ask if they have the final budget for 2024. Anyway, let's just going through the financial reports. The letter from the accountant, I don't really care about. I just want to see that, in fact, they are audited financials. Here's what we want to look at. Here's our balance sheet. Now, what I like to point out is we always want to be looking from 1 year to the next year because that is how financials are set up. So when we look at 22 here, we see that in 2022, the assets seem to have been greater than they were in 23. And so one of the questions that might come up is, what happened between 22 to 23 that made the assets change by a total of almost, looks to be about $4 million, $6 million. Now, I don't need that answer right now, but that's just something I would automatically see from it. I also see that I see reserve funds. Why is that interesting to me? Well, it's nice to know how much a building has in reserve. Well, you can't look at assets without also looking at liabilities. When we come down here, we also see that the liabilities, because of course they're depreciating, accountants depreciate the assets along the way. So right now, just looking at this, what am I looking at? I'm looking at how much was, what were the expenses, and did they get higher? Did they get lower? You can see here, the total amount of the expenses had been, the accrued expenses, I should say, they did increase. Why did they increase? Something that I'll want to look into. Now, from a broker's perspective, for those of you who are brokers, the only thing that might be here that I would want you to just kind of note to yourself is real estate tax refund receivable. What does that mean? Well, what it means is that the building may have applied for the co-op tax abatement, also known as the co-op condo tax abatement. You see special assessment receivable. What does that mean? I haven't even looked yet in my opinion, you know, before you're even looking, I'm now saying to myself, is there an actual assessment that we have to worry about? Or might this just be the assessment that gets issued to offset the abatement from the co-op abatement? We don't know yet, but that's what's going on in my head. I'm guessing that it's going to be that because generally speaking, that's what a special assessment would be. Accounts receivable just means that there's money owed to the corporation. Real estate tax refund receivable, not sure what that means. Why is it there in 23 and not there in 22? Don't know the answer yet. Now what I want to really see is I want to go into the revenue and expenses, and they only have here on this the 23 budget. Maybe by now, though, they would have the 24. The likelihood is that they do. So going through, we can see that there are sublet fees. What does that tell us right now? If you're a broker, you're doing your first deal at the building, maybe you're on the listing side. If you're on the listing side and you were to obtain these financials, which you should be doing as soon as you have the signed exclusive, get yourself familiar with the building. This might be the type of building most people are somewhat familiar with, but not necessarily. When you look at the revenue that's coming in, we want to know what is the revenue, where is it coming in from? And we see that there are sublet fees. Right there, that tells you as the broker, subletting is allowed, but there are fees paid for. What are those fees? Who pays those fees? Why is that important? Well, maybe the buyer is somebody that plans on subletting the apartment at times. Well, then we need to know, is there going to be a cost to them to do that? Something that might be important to them. Swimming pool and health club generates revenue. What does that mean? And who's allowed to belong to it? Are tenants allowed to use it, or do you have to be a shareholder? Are outsiders, people that do not own at London Terrace, are they allowed to use it? Commercial rent. Commercial rent showing us that there is rent, monies are coming in from commercial property located at London Terrace. Generally speaking, those would be, if you knew nothing about the building, you can assume that that is going to be ground floor commercial space. Not always the case, but often the case. It's not uncommon where you'll see a residential building, it would have the commercial space on the ground floor, and your second floor might be professional space. Laundry. It tells us how much revenue is collected from the laundry machines. That means that somewhere in the building, there is laundry and shareholders must pay to use the laundry. Now, what that might also tell us is that washing machines might not be allowed to be used in the apartments here. We don't know that just from seeing the financials, but I can tell you that generally speaking, when a building puts in a laundry room, they're doing so in buildings that they do not want owners to be using their machines. Now, I know some of you out there might be saying to yourself, well, a lot of times washing machines get grandfathered in. Well, I can tell you definitively that most of the time when you hear that a washing machine and dryer is grandfathered in, it's grandfathered in for the then current owner that owns the apartment at the time that the rules have changed. And the theory behind that is that if you already had it, they're not going to make you get rid of it, but it might mean that if it's sold, that you're not going to be allowed to have it. Expenses, we always want to look through. What are the expenses and what are we looking at? So here's your differences in years. We can go from 22 actual to, let's say, 23 actual. And we're going down looking at expenses. We basically want to see, has anything drastically changed? Nothing looks too drastic here from one year over the next year, other than real estate tax reductions. That may mean that the building didn't qualify for the tax abatement at some point in time. It looks like that may have happened in 2022. Maybe something happened there, maybe they didn't submit for it and therefore they didn't qualify. I'm not really sure. Or maybe they just didn't get, the city might be way behind and they may not have yet adjusted the records. Can't really tell from here. Now, you're always going to have a certain amount of expenses that will come up year over year. Here we see salaries and wages, presumably that's for porters, it could be for building staff. It's a big complex, so there's certainly a lot of employees, an employee benefits plan, payroll taxes, disability. Maybe the question comes up, is this a union building? Don't know the answer to that yet from there, but that's something that might be coming up. Administrative fees, again, we're seeing the health club management fees. So there's a cost to running it. Is there a cost to using it? Don't know yet. Accounting fees, plumbing, elevator. What we want to know is the building able to cover its actual expenses? So now we're looking at the budget, and what we see here is that the building is running positive, but when they start adjusting for the debt and the depreciation, which we don't need to be looking at that. I'd rather you guys just look here and see that as far as just straight income over expenses, the building is running cash flow positive, not negative. Now, very important to see cash flow, again, I don't get too caught up on this. We looked at the categories. I more want to see this stuff for category purposes. I see that there's real estate tax abatements here. We want to get a handle on, if I'm looking at this building as a buyer's attorney, I want to understand whether or not, if my client does occupy as a primary resident, is the building getting a tax abatement? And is that abatement being returned to the shareholder? Or is there an assessment that's going to be charged as an offset to the abatement? And then if my client is not going to be a primary resident, we want to know whether or not the building is assessing the non-primary resident shareholders. And presumably the answer to that will be yes. And so basically what happens is the amount that a non-primary shareholder would be entitled to as the abatement, if it was their primary residence, now gets charged to them as an assessment instead. The next thing we're going to start to look at is what's called the notes section. And the notes section of financial statements will teach us a real lot about the building. So now, like I said before, if your building is a co-op and you're the listing side of it, you haven't listed it yet, and you're now getting ready to list, getting the financials and looking through the notes section will be extraordinarily useful to you. Why? Well, because looking at the notes, look what we have here. It tells us how many apartments there are. It tells us how many shares of stock are outstanding entirely. Why do we want to know that? Well, the most useful part of understanding the total amount of shares is if you or your client or a buyer, anybody ever wants to know, what would happen if all of a sudden the building had to replace every single front door to the buildings? What would that mean to each individual shareholder? How much would that cost? And so now, once we receive the estimate for what it's going to cost, we can then take that estimate and we can divide it by the total amount of shares and to figure out what will the cost per share be. And it's that cost per share, it's the amount of shares that dictate what each shareholder's responsibility is vis-a-vis expenses of the building. What is a particular shareholder's maintenance? The maintenance is going to be based upon the dollar amount per share that maintenance, how the maintenance is charged. And so, and keep in mind also, for those of you who are unaware, when we're dealing with cooperatives, you can't base the shares just upon the same layout. The number of shares, a lot of different items go into the determination of how many shares get allocated to a particular unit in a particular building. And that can be based upon the view, the floor, whether or not there's a terrace, how many bedrooms, how many bathrooms. There's a lot of factors that go into it. It tells us here whether or not the sponsor of London Terrace still owns shares of stock, so we know that information. Accounting principles, I don't care, you don't need to look at that. For your purposes, the only reason why you're looking at the financials is to see if anything jumps out at you that you are unaware of. Does anything jump out? Is there any tremendous charge that didn't exist the year before, or a large credit? Where is the revenue being generated from? Again, just talking about how much cash the building has on hand. Now we're going into the notes section. And here we have that there are accounts receivables which were collected by management as prepaid tenant charges. What does that mean? Well, what that might mean is there might be shareholders that had to pay extra money as security during their purchase. It might mean that there's maybe tenants, there's a sponsor space or somebody that the board still owns that they're getting paid on in advance, or there's an extra security deposit. Can't tell from this, but just something to note. Nothing really for the brokers, more so for the attorneys or purchasers. Now, depreciation, again, accounting principles, not really worried about that for our purposes. Now, transfer fees. That's interesting. If I'm the listing agent and I'm going to put this property on the market and put it into the MLS, I better know what the closing costs are. And if there's a fee that we're charging to a buyer, I better make sure that I put it into that listing. Because if you don't list a charge and you accept an offer, do not expect your buyer to want to pay it. Once an offer has been accepted, it's much less likely that a buyer is going to be okay paying more when they made their offer, when you hadn't yet disclosed what those additional charges are. And here we're talking about a 1% fee. And this is 1% of the sales price. What they're saying is here they want 2% total, and they want it to be 1% from the transferor, which is the seller, and 1% from the transferee, which is the buyer, which is a 2% gross sales price. Let's just say you know that the transferor has to pay 1 and the transferee has to pay 1, also known as the seller and the buyer. Be careful. Don't let your client convince you to just put the whole thing on the buyer, because then what happens is the buyer hires an attorney, and that attorney, unfortunately, too often, they want to look like a hero. And now the next thing you know, they're telling their buyer that, why are you paying 2% when the financials say that it's supposed to be 1% paid by the seller and 1% by the buyer? Avoid that altogether. Just do as it says in the only way that you can do something different than is listed here is if you, the seller, are going to pay the full 2%. Then you don't have to mention the transfer fee. If, let's just say, your client has a unique property, and now you've just learned that there's a transfer fee, if you think that you can get the full ask that would make your client happy, but you think it would sound better if your seller paid the transfer fee, then put it out there. Say, seller's picking up the full transfer fee. Put that in the listing. But what you cannot do is not list something and then expect to collect it. Now let's into, now we're seeing that the building has a mortgage, right? So the building's mortgage is 82 million and that matures in 31. And it tells us what the payments are. And the part about here, though, which is going to make people think, right, is, well, 2031 is 6 years away, and it's a 2.3% mortgage. What is that going to look like then? Well, we really don't know the answer, but presumably it will be a lot higher. How will they deal with that? Well, we really don't know, because it's going to depend upon how much money the building has. Like I said, there are transfer fees that are due. There's 2% transfer fees. Those transfer fees are the reason why they exist. You noticed they came up in 2018. Why? Because older co-ops need a way to raise revenue for their buildings. And one of the ways that they do that is by implementing a flip tax or a transfer fee. And that happens a lot. It started happening a lot when buildings hit years where, well, might need to upgrade some plumbing, might need to upgrade electric, might need to replace certain systems in the building. And so by charging that transfer fee or flip tax, as it's called, it allows the building to build up more of a reserve. And most of the monies accumulated through the transfer fees, that is what they're for the building's reserve. So now, we spoke a few moments ago about how many, why it's important to know how many shares there are. Well, if somebody wanted to determine how much each shareholder would be paying if the mortgage for the buildings had to be paid off, they can take the total amount of the mortgage. They could then take the total amount of the shares, and they can, first they could also take out, maybe what's in the reserve, assuming that they would pay some of it off. We don't really know how it's going to work. And we also have about another 6 years now, thankfully. So that is something, though, as we get closer to 2031, that might be concerning to people. It all depends. It depends how much this would cost for all the shares altogether. Now, tenant owner charges. Remember, I was saying before that all charges in a co-op are going to be based upon a per share charge. So we can see here how much is charged for each share of stock that a shareholder has in the corporation. And we can see that it went up to $41.95 in 23. Now, the special assessment revenue, what they did there, they did issue a special assessment, and these were the different years. I don't know yet if that was because of the tax abatement or not. I'm inclined to say it wasn't, because if you recall, there was no tax abatement listed. I believe it was in 22. Anyway, keep going on here. We see there's electric sub-meters. Now, what does that mean? I don't know. It doesn't mean much, although there is a per share charge. So as of 2023, the building decided to sub-meter, and now they're charging a per share for each tenant. It probably was included in the maintenance before the building realized, the co-op realized that they needed more power. And in order to do that, maybe they wanted to shift things around and started making changes there. Again, talked about whether or not there's a union. Why is that relevant? It's not particularly relevant to any one shareholder. It's relevant to the extent that we know that because this is a union building, they do need to pay prevailing wages. And since they are paying prevailing wages, that means that they would qualify, presumably, for the co-op abatement. And maybe that's part of where the structure changed. I'm not really sure, hard to tell from here alone, but again, interesting information for somebody to know. Certiorari proceedings, what does that mean? That means that the co-op hired an accounting firm or a tax certiorari firm to apply for a reduction in taxes, which they did, and taxes were reduced. And apparently there were refunds given. Now, as I said before, most of the time, those refunds aren't actually given, and instead, they assess the shareholders, which is what they did here. And so there wasn't actually money given back, it was offset. Water and sewer, expenses that all buildings have in New York, just saying what those expenses are, and you can see that some of it is charged to the commercial units. Taxes, not all that relevant. Like I said, the main thing that I want people looking at here is what can I find out about this? So now we go into the real estate tax abatements. And the law had recently changed, and it was in 23. And that's when it provided that you can only certain buildings can get the primary residence abatement. And so they extended this law through 2027. And as long as it's your primary residence and you don't own more than 3 residential units in any one development, as long as it's not your business, as long as it's not an LLC, if it's a trust, but it's your primary residence, it's okay, then you would qualify for the abatement, and otherwise you would be assessed. That's very common in New York. Now, here's some interesting information. Other tenant owner charges. If you're the listing agent on this deal, now, what else do you learn about this building? Well, you may not have known that there was storage in the building. Now you do. You may not have known that there was a bicycle area to keep your bikes. Now you do. Appliance fee, what is that? Again, now you want to know, now that you got this listing and you picked up the financials, you're going to want to make sure before you list, you need to know whether or not the unit that you're listing has a storage facility, where is it located, and is there a monthly fee? Most importantly, does it transfer with the unit, or does it go back into the pile, and is there a waiting list to obtain a storage room, a storage box, a storage crate, whatever it is? So what I tell brokers is, use the financials to learn as much about the building as you can. If you just skimmed through these financials and just looked at the words, you would now learn, well, there's storage. Oh, you can have a bicycle. What is the appliance fee? These are questions that you now can ask the management company. You can ask it to the seller themselves. Maybe they don't have a bicycle. Maybe they don't have storage, so they don't have the answers. Go to management. Ask a lawyer that you work with. Commercial rent. Why is it important to know if there are commercial tenants, and if there are those spaces rented, and are the tenants paying their rent? Well, it's very important because oftentimes buildings rely on commercial rent for a lot of their carrying costs, and they count on that revenue. You know, during COVID, there was a time when a lot of commercial properties left, commercial rents weren't being paid, and that was really hard on the buildings. Now it tells us what the commercial rent is, and what I would want to know as a lawyer looking at the building is whether or not the commercial tenants are all paying. So that's one of the questions that you might put into a questionnaire. Capital stock, we don't really care about that. Here we're looking at a commitment for what? Well, it looks like they're going to be upgrading the elevators in 2023, and they entered into a contract for 3.795 and change million. They paid their deposit, and that was what was needed for the to include for the building improvements that had to be done, and they're just showing where it went onto the balance sheet and what each amount was allocated for. Now, claims and litigation. Why do we need to know that? Well, it's always important to know whether or not a co-op or condo is undergoing any form of litigation, because that might affect whether or not a lender is going to loan in the building. Now, by the way, remember, when we saw that the $82 million loan is coming due in 2031, keep in mind, if somebody is getting a mortgage at the building, that bank might require something in writing from the building indicating that they will be refinancing the loan. The reason why they'd want to know that is they're not going to want to go and give a 30-year loan if this is a building that's not going to have a loan, and all of a sudden the maintenance is going to go way up there, or there's going to be a greater burden on the shareholders. So it's always important. A lender will want to look into that information. And no litigation here. So that's really it on the co-op financials. I'm going to pull up right now. Condominium financials are really not all that different. There's just some different information that you're looking at. I want to go through this one the way that I want you to go through your financials if you're a broker. And this is Cobble Hill Towers. Now we're going to start at the same place we started last time, which is bringing us right to the balance sheet. What can we find out about this building? Let's see. Well, there were more assets in 23 than 22, so that's a positive sign. The reserve fund went down. We're not sure why it went down, but there is a reserve fund, so there's a positive. And the reserve fund, remember we were talking before, I had mentioned how you want to look at the income and expenses to see how it went from one year to the next year and whether or not they're running negative. Well, let's look at the income and expenses here, and that's going to help us determine how that reserve fund looks. See, a reserve fund, remember we were saying before about 10% of the annual expenses. Well, they have $500,000 on the reserve fund for this particular building. And we see that the annual expenses for the building are 1.2. So they already have about, call it 35% of the annual expenses in a reserve, which wouldn't necessarily satisfy the Freddie Mae Fannie Mac requirement of the line item of 10%, but it is showing that there is a reserve here. So now let's just analyze this a little bit more. Let's look at our balance sheets. We see that the common charges collected are just slightly higher than the year before, which is fine. We see that there's an assessment. That assessment, is that the condominium assessment? Probably not, but maybe for people that don't occupy as their primary residence. On condos, it's different though, because the individual unit owner applies for themselves. But the building, because the building could end up getting taxed, the unit itself gets taxed. And so there might be an assessment against the non-primary unit owner. Now, as far as expenses are concerned, what do we see here? Well, we see a working capital contribution. What does that mean? We're not really sure. I'm going to guess that it means that there's a capital contribution that's due when units transfer hands. It's usually a 1 to 3 month common charge fee payable by a buyer. Is that what this is for here? We're not really sure. They're listing a flip tax here, which is unusual because it's a condominium. It's not really a flip tax when it's a condominium. It really should be listed as a transfer fee. However, not uncommon that condominiums financials call them flip taxes, even though it's really not a flip tax. So we know that there's some sort of a transfer fee that's due when the asset transfers. As the listing agent, if that's a fee, whether it's the capital contribution or the flip tax, if there's any of those fees payable by the buyer, don't forget, you want to put it in the listing. If it's not in the listing, don't expect to get it. Here they have the reserve fund, and it's showing, because look at this, this seems to have changed a lot. 23, the reserve fund, it was 1,153,000, and it came down a lot. What was that for? It seems that there was a capital expense that went in. Cannot tell just from this. I'm sure we're going to find it in the notes, though. I already learned that there's a transfer fee when the units transfer. I just don't know exactly how much yet. So that's a good question for me to find out from my seller or from management before I list. We know that the buyer pays something because it's a working capital contribution, is usually a buyer's charge. And we know that there was some form of capital expenditure of over $1 million between 22 and 23. And we might want to know what that's for. That's a question that a buyer's attorney might ask. So as a broker, that's something that would be good to get ahead of and just know your answer there so that you can share it. Now we're looking at your operation expenses, and we should be going now to straight from there, just talking about our cash flow. Reserve fund again shows up here. Now we're going to start going into the notes section, and that's going to give us our details about the condominium itself. Now, this is a small condominium. It's only, well, I'm sorry, it's a large condominium, but it's 9 buildings. So we don't know yet from here how many units are in each building, but we know that it comprises a few different buildings. There are also sponsor units owned, as it says, and it's telling us that all of these buildings together comprise 188 units. So over 9 buildings, there are 188 units. That doesn't yet tell us how many units are in each building. They might not all be the same size. We'd want to know, of course, what unit this one is in. But remember, when you're dealing with one condominium, it's going to, the charges for the condominium will generally apply to the entire condominium. Now, there is an association and there are fees for the association. And it also talks about different assessments. And basically what it's saying here is that they had retained an attorney during this last year, and they had put liens on the properties of the homeowners association. And what happened was that then in 23 and 22, the board had approved a $500,000 assessment across all of the units. And the reason for that was they needed that money in order to bring it into the building. And I guess it was for costs that they had here. It may have been some of their legal costs. Now, property and equipment, again, not interested in depreciation from the broker's perspective or from even the attorney perspective, really. This just tells us how they're valuing each aspect, each part of the building. Now, when we look at the offering plan, this is kind of summarizing some of the information from there. And I can see that the sponsor was supposed to contribute 3% of the sale prices of its units through 2017. And it tells us how much the sponsor contributed through 23. This is specifically for repairs, not uncommon. Now, here's our working capital contribution. It tells us that when units are sold, they have to collect money and how much gets collected. Again, flip tax, 1% of the sale price goes to the association, and that's just going to go into the reserves. It tells us how much was paid. What it doesn't tell us here is who is responsible for paying it. So before you list, you're going to want to make sure you know what in the bylaws, who it says is supposed to pay that. If it doesn't say, my recommendation, have your seller pay it. Or just know if you don't put it in there to have that, if you don't list it, that your seller will end up paying it. We want to see how many sponsor units there are. That might be relevant for a lender that's loaning there. And it tells us how much, how many of them are still sponsor held. And here we see that they sold 129 and they still had 62 units. That might be relevant for somebody borrowing money at the time. Management fees, maybe just telling us that there is outside management. There's an underlying mortgage here on the building. They tell us how much it is, when it expires. Maybe somebody wants to know, well, how is that going to affect my client? Well, take the 450,000 divided by the percentage of common elements that goes with this unit, and you can figure it out that way. Let's see, they're working on the facade of the buildings, gives us an amount. There's not even anything else here other than just a schedule. Oh, well, the schedule of expenses, again, you'd be able to go through here and say, what does it tell me? It tells me that their legal fees were less this year than the year before of 83,000. It tells me that there are expenses for repairs that go on at the building, how much they are from one year to the next, nothing outrageous. Insurance costs. So again, this is all for informational purposes. And I just want to go back before we end there, because I want to point out that here we see that there is work being done on the facade, and this was for 2021. And it's telling us what that cost is going to be. Now, it doesn't tell us how it's getting paid. That might mean if I'm looking at this and I'm a broker and I'm getting this listing, this might be telling me that there's going to be an assessment, because where's the money going to come from? So that's something that you might want to know. Is there an assessment coming? So again, the purpose of financials, looking through financials, in my opinion, is to learn as much about the building as you can learn. You can do this on any set of financials. Look for buzzwords, look for any big change from one year to the next year, look for whether or not there's an underlying mortgage, look for when it comes due, see whether or not there are any transfer fees were implemented, look at the notes, go through briefly. You have the opportunity to make sure you list properly. By getting the financials, it can be really helpful. And I hope you gained a lot of valuable information from this class on understanding building financials. Great seeing you all. See you soon.